I'd like to welcome Ann Wickland. With 27 years of investment experience, Ann is a portfolio manager at Easterly Investment Partners, a firm that spans public and private markets across several investment strategies. She currently manages 3 portfolios: the Easterly Snow Long Short Opportunity Fund, a large cap value strategy, and a dividend income strategy. She's going to be a great interest to viewers interested in fundamental investing and risk management. Prior to Easterly, Ann was with Snow Capital, where she was a PM. And prior to Snow, she worked with Prudential Equity Group, Credit Suisse, and JP Morgan, where she was responsible for research coverage in the specialty hardlines, retail, internet, and household and personal care sectors. Got a lot of kudos here for Ann. She's a top 6 finalist, Global Equities Leader of the Year, Women in Asset Management Awards, November 2022. Winner Best Liquid Alts Fund, Equity Hedge, Hedgeweek US Awards, October 21. Top 4 finalists out of 146 nominees, U.S. Value Equities, Women in Asset Management Awards, September 2019. And Ann earned a BA from Davidson College and received an MBA from the NYU Stern School of Business. She's a chartered financial analyst and a member of the CFA Institute. So I want to welcome you here, Ann, and we're so excited to have you be with us today. And we were lucky enough to talk to Jessica, who I understand is a colleague of yours, but I have different questions for you. So we're going to pull out a lot of your knowledge and expertise individually, which I'm excited about. So thank you so much for joining us today.
Sure. Thank you, Nadine. This is such an honor to be even put into this group of fantastic women. So I'm excited about this.
Well, what I'm excited about here is, before we get into any specific investment ideas, I want to step back and talk about your investment philosophy. And when you think about the trajectory of your career, how has your process changed as you've matured as a portfolio manager?
Sure. And I'm not so sure how I got to be a senior investment person. That happened.
Once you're over 20 years of investment experience and you've survived this industry, you're senior.
I guess so. So kind of like going back to the beginning, I would say that we believe that the way to win on Wall Street is by beating expectations. So if you want to beat expectations, where do you go? You go where they're the lowest. So we're looking for stocks that have warts on them, might be on the cover of the Wall Street Journal, turnaround stories, maybe a botched product launch, or management changed, or management needs to change. There's something wrong with the story. But this is also, it's contrarian, but it's also very traditional value. We want strong balance sheets, strong cash flows. Maybe the P&L is broken. And so that's really where we're looking for ideas. And then there's a bit of a behavioral finance overlay. So one of the first screens I look for when I'm looking for a new idea is the A&R screen on Bloomberg, because I love to see a stock that has 1 buy, 10 holds, and 2 sells, because that tells me it's washed out. And you mentioned in my bio, I spent about 10 years on the sell side, and I wrote those reports. I wrote, something falls apart, and then you say, downgrading to hold.
Yeah, right. I'm going to put this in the neutral penalty box for a while, right? Yeah.
Right. It's already down 40%, but no one wants to stick their neck out. So we like to be on the other side of that. We like to play Wall Street against itself. We like to be buying when it's down 40%, knowing that there's a lot of uncertainty. There might still be more bad news. Usually there's 1 or 2 or 3 shoes to drop. There needs to be change, and the market needs proof that things are getting better. And oh, by the way, when you do this, we think the first 30% of upside is the easiest, because you're finally going to beat expectations. Management does something right, and the short squeeze is on, and everybody, feels better about the story. And also, that's when the sell side starts to upgrade, which drives me nuts. Because you wait, it's in the penalty box, things work out, and then all of a sudden, there's $2 of upside left. Yeah. So we're trying to, win that game on the other side. As far as my career goes, I guess I've learned a lot of patience. I think one of the things I have, I don't know if it's a female thing or if it's just me, but I feel like I can read people well. And I've learned that management teams, quality management teams, are probably one of the biggest things I look for. And I always say there's always opportunity, because companies are run by people. People make mistakes, even very good management teams. And to bring up one that's been very recent that we own actually is Target. I mean, there's a quality management team that had, some steps that didn't quite work out with inventory and how they reacted to COVID. But that's one of those things where I feel like I've learned through time to kind of trust my instincts with people. And if you listen closely, you can hear it. And then kind of going back to that looking for upside that's there. When I get on a conference call, not only am I listening to what management is saying and what they're not saying, and a lot of times what they're not saying is really important, but it's also listening what analysts are asking. And if it's a great quarter and management is, or the analysts are high-fiving management, oh, great quarter, oh, good job. And I know that we're kind of on our way for higher estimates, upgrades, whatever it may be. And all of a sudden that sentiment starts to change. And that's where we make our money.
Yeah. And so when you think about, one of the things that you said resonates with me, that it's never just like one shoe to drop. It's usually a few things that occur, either in succession. You might not know that they're coming, but you can usually kind of sense a little bit of what might be coming down the pike. How do you figure out the timing of that, right? It's to say that, okay, people put them in the penalty box because of the first shoe. Do you enter then, or are you waiting for a couple more shoes to drop before you're legging into positions either with, the equity or the options? How do you think about the timing?
That's the hardest part. I actually think it's easier to time the buying part rather than the selling part. I think it's hard to know when to sell and to finally let it go. And a lot of times we sell too early. Again, we're very disciplined about our price targets. So we're not selling before we hit our price target, but the stock will rally another 20 or 30%. And you kind of look back and wish that you've been able to hold on, or will hold on to a small piece. As far as the buying goes, one of the things that we do as part of, risk control is we have kind of a 3-stage way of buying things. And I have a lot of answers for you about this specific question.
We could talk forever, right?
But we look for 50% upside over a 2 or 3 year period, generally speaking. And so we quantify that upside. And the stage 1 buy would be a small bite. And that would be, we think there's 50% upside from here, knowing that the next earnings report might be bad news. And either we'll buy like a 50 basis point position and write an option, a put, because we expect it to go down, and we get paid to take that risk. Or we might have just a 1% position based on conviction. The second stage, or the second add, and this isn't like 1%, 2%, 3%, this is in stages, is when we think all of the bad news is out of the story. And so again, I kind of refer back to that management getting high fives from the analysts, and it seems like there's some kind of evidence of a little bit of proof, or there's a nugget of optimism in that conference call. And then the third stage, in the last final buy, and again, that can still be in different pieces to get to more like a 3% full position, is when the thesis is starting to work. And that doesn't have to be the company's improving. It could be, if pretend we owned a housing stock, maybe I'm starting to see new home sales go up or something like that. So that's kind of how we think about it. But you're right, and we've been wrong. There are times when I feel like things can go bad, they can get worse. And when companies are in trouble, management tends to say what people want to hear. But the proof is in the pudding. But you're right, it's hard to know, and you can't always be right.
And when you think about this approach, I have the benefit of knowing a little bit about Easterly and how you think about, buying, selling options. Does your portfolio success depend on a certain type of market, whether that's up, down, something else, volatile? Because obviously, if you're selling options, you want to be paid for the volatility. How do you think, and value's got its own, ball of wax in terms of timing on that. How do you think about, when you guys, that's your sweet spot for things, and when it's maybe harder to do what you do?
Right. It's kind of all of the above. So certainly a volatile market presents opportunity, and it makes the premiums on those options become more and more attractive. We have hurdle rates that we have to hit. It's just part of our internal, risk evaluation system, I guess I would say. So that certainly helps. Volatility also breeds opportunity. And that's when some names that would be typically too expensive for value managers like us fall into our relative value. So we're not hard and fast, must be below book value, or X% ROE. We're really, if something has fallen out of favor and is not trading where it should, and there's a recovery we can see, that's something that we get excited about. And again, I go back to that management quality comment, because if there's a company out there with a fantastic management team that's just made a small misstep, that's like the most exciting thing of all to me, because I have, a pretty high level of confidence. But it's been, obviously, value's been out of favor now. Well, hopefully back in favor for a bit, but we suffered a good 13 years really in the trenches and frankly thinking that you're dumb and you don't know how to pick stocks anymore. So yes, the return, higher interest rates and the economic situation that we're in with inflation is good for value. But I would also say we had, winning years where value hasn't been in favor. And that goes back to people manage companies, people make mistakes. Yeah. And there's always an opportunity, an idiosyncratic story in the market that is appealing and attractive from a valuation perspective in any single market.
And how do you define value? Because you can go on Bloomberg, MSCI, different people call value different things, either depending on valuation. Sometimes they call it certain segments of sectors. So how do you think about the definition of value? And kind of related to that, what do you think that makes your process or skill set unique amongst value managers?
So value to me is something, I again kind of feel like I'm repeating myself, but something that's trading at a valuation that we believe is cheap, something that is trading below a valuation that it should, and for whatever reason that may be, like I said, it could be something, a stock that's having issues, or maybe, investors also tend to throw full sectors out at a time.
Yeah, that's what I'm saying. It's like sometimes we tech is always not a value, right? Because they'll say X, Y, Z. So, are there certain thresholds where you'll say, no, we just can never have a multiple of that industry or whatever over X, Y, Z? Or is it really it's that discount to intrinsic valuation that you think exists? That's a kind of a different way to think about it.
It's more of the discount to intrinsic valuation. There's not so for example, in the last 3 to 4 months, Jessica and I, my co-portfolio manager, we've started to look into the tech space. And we've added AMD to the portfolio, we added Skyworks, Qualcomm, and you can argue that these are not cheap from a hard and fast, it trades at, 15, 16 times or whatever it is. But because they'd fallen so far from what they were trading at, they became attractive. So that to me became value names, relative value names.
Right.
But, and that's another instance where we're pretty excited about being able to play in a sector that we've been underweight for literally 13 years. We were kind of stuck with the dinosaurs, like the Oracles and the Ciscos and HPQ and stocks like that, which yes, they're very much value names. But they didn't have that growth tailwind behind them that these other high flyers have. So for us, that's been a pretty interesting opportunity that popped up just recently. And to kind of risk control that, instead of taking big bets on just a couple names, we've been taking 1.5, maybe 2% position sizes for each of those, kind of with the idea that the whole sector has been hurt by rapidly rising interest rates, and not having to try to pick which technology or which company will ultimately be the winner.
And what makes your process or skill set unique? When you think about it, one of the things that I've been hearing from you is a lot around process, a lot about frameworks. You're obviously internally have, whether you call it a set of rules or a framework that you're living by in your professional career. Is that something that's special to you in the firm, or what is it you think that is, call it, your secret sauce there of what you do?
Again, I think a lot of it is looking for these one-off names, contrarian names that have fallen out of favor, and identifying what will make them improve in investors' minds over time. But I think another side that we haven't really touched on a lot is the risk control around these names, because value stocks tend to have problems, like I've said, or they're undervalued for a reason. There's definitely a bear case out there on these names. And they can and do get worse. Sometimes you're catching a falling knife, and oh, by the way, that knife will fall even faster. We found that out during the financial crisis, frankly. So I think, I kind of think about risk control around the names might be some of the secret sauce. And I think about it in different buckets, with risk being more something I can't control. And, my husband would tell you that Anne doesn't like things she can't control. And yet I work with a living, breathing, 9:30 to 4 p.m. You can't control any of that. So.
You can't even control what your day looks like. That's why I try to explain to people, it's not like you go schedule your day. You might have some things scheduled, but you never know what your day is going to look like.
Right. You walk in, you've got an acquisition that's just been announced. So it's, so I kind of try to think about risk control as part of what we do to make this work. And part of it's that company risk. So you want a strong balance sheet, a strong cash flow to support through the turnaround that's going on. I talked about how we buy in stages. So that kind of gives us some room for things to get worse. And if it gets better, we'll buy more. We didn't talk too much, but options, using options around buying and selling. The nice thing about how we write puts and write calls, it creates guardrails. And so what happens is you say, oh, I really like this stock at 40. Well, now it's 35. Well, I like it anymore. And if you wrote a put on it, you get paid to take that risk. But you already like the name. It's not speculative options trading. It's really kind of, again, putting guardrails. So if the market falls, then you're forced to buy. We were in a situation in December, I think it was 2018, where the market fell apart and right at the end of the year. And the market was down, I want to say like 10, 15%. And all of a sudden, we just became more and more long, and it was so painful. But that's what this, that's how the options help with that. The flip side is the market keeps roaring higher and higher. We've written calls at our price target, so it forces us to sell. So it's kind of a nice built-in risk control mechanism on the company side. And then if you think about risk from a portfolio perspective, we're taking, like I said, we nibble in, we come in, we add as we go through. I mean, it might take us a full year to build a full position. It might even take longer depending on what the company is doing. So you have position size, obviously diversification that we've all learned. You need to have diversification. And so you've got the company risk profile, you've got the portfolio risk. And then the nice thing about the product that Jessica and I run together, we can also hedge market risk. So we short the market. We're not leveraged at all. So it's typically 75 to 80% net long. And we can use options to hedge the market. So we'll have situations where we can buy a put, like 10 or 15% below a certain strike, and then we'll sell a call to fund the buying of the strike. And so that kind of gives us protection. So I think as I've matured, I've realized that, again, volatility isn't bad. It's trying to control what you can't control and still deliver performance.
And how far out are those options that you're writing? Because, it sounds like you have at least an intermediate term view on what management in a company is going to do. But obviously, the longer you go out, so you might get paid more for giving more time for somebody to reach. Let's say you're, selling a put. That it gives them more time to get that stock back to you. But how do you think about, do you layer it in? Is it over the period of your thesis? How do you think about the duration of that?
A lot of it has to do with what the stock is doing. So if we like something and it falls apart, we'll definitely write something that might be shorter dated. So we, with the idea that we want to build a larger position. Sometimes they're longer dated. One of the most refreshing things is that when you have a stock that's not working and you start to lose patience and it comes down to, do we sell it? What are we going to do with this? It's sometimes cathartic to wash your hands and sell the name, knowing that maybe in a year things will be much rosier, and then you can buy a call if the price is right. So I guess the answer to your question is it depends, but typically they're about 6 months out, something like that. Again, and we have hurdle rates that we want to hit to make sure we're getting the return on the option.
Got it. And, with expectations changing daily or weekly in terms of growth, inflation, rates around the world, and questions of, I would say, liquidity, credit coming down the pike, other than banking on volatility, where do you look for opportunities today in 2023? Where are you seeing the most interesting opportunities?
Yes. So opportunity kind of in two forms. From a macro level, one of the things I'm the most excited about is that I think we might be on at the very beginning of a run in value over growth. And again, having lived in the desert for 13 years, and when the S&P 500 was dominated by FANG stocks, it was really painful to sit where I sit. So that I hope, and I'm opportunistic that we're going to go into a new era for value investors and that we'll be rewarded. Second, and I might even be more excited about this, to be fair, because I run a large cap product, is people who hung out in the FANG stocks and the S&P for the last 13 years were brilliant. It was an easy set it and forget it, and you were paid well. I sit on 2 investment committees, and they're always very quick to take the large cap piece of the portfolio and maybe even the mid cap and just put it in an index. And so I'm hopeful with the dislocation that we've seen in the market, especially in the last year, down 18%, that people will realize that there is real value to stock picking and active management once again. So again, I guess I'm talking my own book. for
But if you
jobs.
didn't believe in it, who would?
But I do hope and think that maybe we're on the, maybe we're going to go back to what it looked like, asset management looked like in the 90s and the early 2000s, when we could actually make money by picking stocks.
And you talked about tech, in terms of names. You talked about AMD, you talked about Qualcomm. Are there other kind of names that either you didn't think you'd get before and you're getting? You talked about Target too, had a stumble, high quality management team. Are there other names you'd say, gosh, we're not, whether you're in it or not, happy for you to talk your book or not, you'd say, gosh, these are ones we're watching or things that are interesting to us?
Definitely tech. That's been, I think, the biggest news of all for this portfolio, because we've been, like I said, really hanging out in stocks like Intel. We actually had Intel for a while and finally kind of just threw in the towel on that one. So many other attractive tech names out there. So we've been underweight, I think, my entire career in IT, and we are bumping up towards equal weight. So that's kind of like flashing headline for us. Yeah. Industrials, we're waiting for them to roll over. I think they're all too expensive. I mean, I really feel like have you seen that? I'm sure you've seen these charts of the Fed, how fast the Fed has hiked. I mean, it's parabolic, right?
Yeah.
We've never lived through that before. And I don't think that that's completely filtered through the system. And so I think that, fourth quarter earnings were okay. I think they're generally better than expected, but we've been kind of building cash with the expectation that there's going to be some more really high quality names that go on sale. And so far we haven't, Disney fell apart. So that wasn't, we own Disney. We added more to it because we're long-term holders. Today, the market's throwing out banks, which is short-sighted when you've got, these net interest margins are ever expanding. Obviously, the cost of deposits is probably the biggest bear case against the banks. But as long as people stay employed and don't think they're going to lose their jobs, they're going to keep spending. And so credit may normalize, but they're also going to borrow on those credit cards. There's just a lot of opportunity for banks, I feel like, and they've been overcapitalized for years. So that's another area where we've really been shifting into the money center banks. As well as, we've been long financials in general, but certainly insurance companies, some of the other interesting, and you get paid a dividend, by the way, while you sit in these names. So definitely see opportunities there.
We're in Japanese banks, so.
Okay.
Because it's like, when have you seen them in raising rates? So it's kind of an exciting time for a Japanese bank.
Right. When's the last time they did that? Like in the 90s?
Yeah, exactly. To talk about value. So, one of the things that I like to hear from great investors is, how you define risk. And then how do you incorporate that risk management in your portfolio construction and security selection? Like you've talked a bit about it. Part of it is where you're hunting for your opportunities because they're less loved. So certainly they can become even less loved than what you thought. But it sounds like where you're fishing is one answer to that. But then also your use of options, whether, writing options or using options, hedging the market. Are there other ways that you would say that you define risk and then deal with risk in terms of your execution of portfolio construction or security selection?
Yeah, I talked a lot about that before, both from a company portfolio and then kind of a macro perspective. Kind of to answer it in a different way, one of the things I love about managing a portfolio with somebody else is that you play devil's advocate to each other. So as I mentioned, Jessica and I have worked together for 16 years. And we're kind of like a work marriage, if you will, and I think we balance each other out very well. I feel like I might be a bigger risk taker, but she's better at risk control. And so the dialogue between the two of us, like she might come in and inevitably, or 50-50, she might come in and say, I think, there's too much risk in this name. I think we should trim it or sell it. And I might say, well, I think there's more upside. This is X, Y, Z. And over time, we tend to, again, we each have our own report card of times when we were right.
You're still together, so it works. Yeah.
Right. And so I think that's kind of like the qualitative part that you just this constant questioning each other, talking about the portfolio ad nauseum every day. In addition to all of those quantitative things that we have in place with options and strong balance sheets and quality management and all those other pieces. And that that might be like the most magic of all, I think, is just the way that we can.
Human capital and good partnership.
Yes, thank you. That's the better way to say it.
And, looking back, what is one of the greatest lessons in your career, either, that you learned about yourself and dealing with your career or in investing in general? Is there anything that you could share with people who might just be getting started in this or are on their journey and are interested in hearing from your perspective?
I think it's patience and longevity. I lived through the financial crisis. I lived through 9/11. And I've lived through bear markets. And I think that the last 5 years or so, it's really easy to think that markets only go up. And it's finding ways to, one, survive even from a career perspective through markets like that. But also just understanding volatility, it can and will get worse. And sometimes you don't realize how bad it can get. I mean, I remember sitting and watching, I think it was the S&P hit like, what, 6, was it like 660, something like that? And thinking that the Federal Reserve, we were just going to all blow up, right? The Federal Reserve.
Yeah. Yes. Yeah.
Right. And so I think it's perseverance is a big piece of it. Obviously, you've got to be right 60% of the time in this business to be able to survive. But on the flip side, I think I've also learned humility. We have this saying in the office that there's, you're the most humble when you're raising children, picking stocks, and then I would add, trying on swimsuits in March. But there's a point at which you have to come in and say, you know what, I was wrong. And maybe I might be right at some point, but the timing is not right. And I need to take my lumps, step on the sidelines, and back away from this and maybe revisit it later. And I think that a lot of times in this business, you don't find a whole lot of humility because you have to talk yourself into thinking that you're right and the stock is going to go up, but it doesn't always work that way. So I think being true to yourself and understanding that you can be wrong and you will be wrong. That's a big piece to career success.
And it's getting comfort with that, right? I think that in other, like if you're a surgeon, you can't be as wrong as we are day to day, right? So if you're in this business, you're going to be wrong a lot, whether just one piece of your thesis didn't work out or somebody else is using your security, to short because they're hedging it for something they're long. Like there's always going to be something that throws you a curveball. And you just have to get back up. And as you said, make a decision, make a good decision, and then strive for that consistency that overall your talent and the luck will overcome call it the mistakes and the lack of luck.
Right. And luck is a piece of it too, that you can't always rely on it, certainly. But you're right. I mean, we might lose millions of dollars, but we don't have to operate on somebody and hope we don't,
So last but not least, go ahead.
Oh, I was just going to say, the other thing I realized is how much I love this job because I'm never the smartest person in the room. I learn something new every day. And I can go to any cocktail party and talk to anyone about, this much of whatever. So it's a lot of fun. It's always changing and it's a great business to be in. And at the end of the day, I mean, this is the only business where at 4:00 every day, you knew exactly how you performed versus all of your peers.
Yeah.
Equalizer, if you will.
Yeah. And as you said, humble, right? Is you can't be going, like, I remember when I was doing private equity, you'd work for 9 months on something that may or may not to come to fruition, right? And so that just doesn't happen here.
Right.
So last but not least, how can folks find you, Anne, either to keep abreast of what you're doing or get in touch with you personally? What's the best way to reach you?
Sure. Well, I would say check out our fund. It's called the Easterly Snow Capital Long Short Opportunity Fund. But the best way to remember it is the ticker is SNOIX. I always joke, it's kind of like Scooby-Doo, like Snoix. But you can find me on LinkedIn. You can find our website, easterlyassetmanagement.com. I'm not really on Twitter, but.
Yeah. Well, fantastic. Such a pleasure, Anne, speaking to you today, and also Jessica. And I learned so much from each of you in different ways, but also good news, consistency on what you're doing. So that's always, I'm kidding, a positive sign. But there's just so many talented people. And, I find this to be such a joy to hear and feel your passion and learn about what you do. And, I always think about this as it makes me a better investor too, to hear, how do you manage risk? How do you define risk? What are you looking for in terms of opportunities? What are you seeing this year? So I appreciate, giving us your most valuable asset, which is your time. Thank you.
Well, thank you so much. It was great to meet you and to be a part of this. I appreciate it.
We'll talk to you soon.
All right.